The team at Technology for Hotels knows how busy you are, so we've created this concise briefing to keep you up to date on key happenings in the hotel industry. Let's dive in. Welcome to this deep dive. We are covering enormous ground this week.
We really are.
Tracing capital movement from major acquisitions across Asia, looking at some critical financial divergence, especially in the U.S. market. And we're really zeroing in on the hard ROI data that confirms technology is now, well, it's a mandated operational efficiency tool. It's not just a guest perk anymore.
Exactly. That's the key takeaway up front, I think.
Our mission today is to give you, our listeners, a true strategic overview of where the industry seems to be positioning itself for, say, the next 18 months.
And what's fascinating when you look across the board is how this narrative around sustainability and advanced technology, it's just woven into almost every major announcement now.
Right. It's not optional anymore.
No, it's not just a little note in the press release. These investments, they're defining core strategy, and we see it immediately in the new property developments coming online.
Okay, let's unpack this then. Starting with Section 1, New Openings and Developments. Radisson Hotel Group, they finally debuted the Park Inn brand in Australia.
Down in Melbourne, yeah.
Melbourne Carlton, 89 rooms. Now, it's a relatively small footprint, but the message seems loud and clear. They are leading with sustainability, providing solar energy covering up to, what, 80% of the property's power needs?
80%, yeah. And water-saving fixtures throughout. It's significant.
And they're linking this directly to the guest experience. The general manager is quoted calling it feel-good, stress-free hospitality.
Which is smart. It connects the back-of-house investment to the front-of-house promise.
Yeah.
And, staying on that continent, Accor is continuing its massive push into New Zealand.
They're growing faster there.
Absolutely. Up to 49 hotels now, over 6,200 rooms. And they're specifically using those lifestyle brands to fuel that growth. You've got the launch of Tribe Auckland Fort Street and the Asia-Pacific debut of JO&JOE Auckland.
That focus on lifestyle brands, it's such a clear bet on the future traveler profile, isn't it?
It seems to be. And Accor's confidence looks justified. The sources point to a 1.5% year-over-year occupancy bump in NZ tourism, which is a pretty solid indicator.
But it's not just shiny new builds, right? We're seeing huge redevelopments, too.
Yeah.
Choice Hotels' Ascend collection is sinking multi-millions into transforming the Bayside Geelong Hotel and Apartments.
Yeah, this is a major repositioning effort. By late 2026, it's aiming to be a 4.5-star, 110-room boutique offering. Stage 1, which is done, delivered 79 new rooms and a new restaurant, Franca's Ristorante.
Okay.
But the key detail for me, again, is that focus on modern operational standards, 10 dedicated accessible rooms, solar power, EV charging stations.
Checking all the boxes.
They really are. Inclusivity, green operations, the works.
And speaking of upgrades aimed at specific segments, the Adina Barrack Plaza in Perth just wrapped up a $4 million refurbishment. Serene Capital was behind that.
Right, and this wasn't just a cosmetic touch-up.
No, it sounds like it's centered squarely on technology. New smart TVs, better Wi-Fi, updated door lock systems, clearly aiming for that long-stay corporate and leisure market, especially with the new ECU City campus nearby.
Makes sense. Then you've got the heritage properties. Blending old and new is always a challenge, but Brisbane's iconic Breakfast Creek Hotel, 135 years old, is tackling a $2.75 million transformation.
Wow.
Phase 1 should be done by November 2025. They're redesigning the Spanish Garden Steakhouse, adding a new pizza kitchen. It's about keeping that heritage charm, but bringing in modern features like a dry-age meat cabinet in the steakhouse.
Nice touch. Okay, before we move off developments entirely, we have to mention strategic alliances.
Yeah?
The partnership between Wyndham Hotels and Resorts and Ovolo Hotels, it's really interesting.
It is. Ovolo brings that, authenticity, the individuality, the design-led vibe.
And Wyndham brings the muscle.
Exactly. The global distribution, the loyalty program machine. It's sort of the perfect marriage to meet what travelers seem to want right now.
Which is
unique design-forward stays, but they also want their loyalty points and a seamless booking experience worldwide. We'll see those Ovolo hotels fully plugged into the Wyndham systems this November 2025.
Got it. Okay, switching gears slightly, some property-specific upgrades caught my eye too, like the $3 million renovation at Watson's Bay Hotel's top and mid-decks in Sydney.
Turning them into more versatile event spaces, right? And launching that Club Amalfi concept.
Yeah, a monthly Mediterranean beach club thing. Sounds trendy. And then, of course, the global luxury rollouts continue. IHG announced Hotel Indigo Bali Ubud. That's 130 keys set for 2027.
Deepening their luxury and lifestyle footprint in Indonesia, which is a key market. Meanwhile, in Japan, the second JW Marriott just opened the JW Marriott Hotel Tokyo.
In that new Takanawa Gateway City development.
That's the one. 200 Zen-inspired rooms, apparently, and great connectivity just 20 minutes from Haneda Airport.
Very convenient. And Singapore is buzzing with pipeline announcements.
Yeah.
Hilton's planning a DoubleTree debut for 2026.
Yeah, rebranding the existing Hotel Miramar on Robertson Quay. It'll be a full redesign, 344 rooms. They're adding a kids club and, get this, dedicated pickleball courts.
Pickleball. It really is the new must-have amenity, isn't it?
Seems like it. And Wyndham's also busy in Singapore, strengthening their regional presence. They've inked a franchise deal to rebrand the value Hotel Thomson. Days Inn by Wyndham Singapore Novena. That's a decent-sized property, 362 rooms. Reopening plan for August 2026.
Okay, that is a massive list of new keys and strategic rebrands. Let's shift focus now to Section 2, acquisitions and investments, because the capital movement globally, well, it tells an equally compelling story about strategic direction.
Absolutely. And we should probably start with the corporate structure changes.
Yeah.
Cross Hotels and Resorts, which used to be under Flight Center, has been acquired by Sono International. That's a major South Korean hotel group. The stated goal is pretty clear: drive innovation and growth across Asia. They want to combine Cross's luxury and lifestyle strength with Sono's regional expertise and operational scale.
Makes sense. And Hilton, they're definitely not taking their foot off the gas in Southeast Asia.
Not at all. They announced 17 new signings. That's nearly 4,000 rooms. And the focus is almost exclusively on luxury and lifestyle brands.
We're talking Waldorf Astoria, Conrad, LXR, Canopy, Curio, Tapestry.
The whole premium range. Specific highlights include the first Waldorf Astoria in Hanoi, LXR resorts popping up in Da Nang and Phuket, Conrad and Canopy in Bangkok, and interestingly, the Nomad Singapore debut planned for 2026.
They've publicly stated a strategy to boost luxury supply across APAC by at least 50%. That is a huge bet.
It's massive. And speaking of huge figures, that transaction involving YTL Hotels acquiring the Hotel Indigo Auckland for NZD 160 million.
Which translates to about NZD 711,000 per key?
Exactly. That was New Zealand's second largest hotel deal in 2025. And it came with a 25-year IHG management agreement locked in. You really have to ask, is a price point like that sustainable, or is it just a sign of intense investor confidence in Auckland's Midtown precinct bouncing back?
It certainly suggests high-quality assets in prime locations are commanding serious premiums. Meanwhile, over in Japan, REX J-Rite continued its methodical expansion.
Right, they picked up the Holiday Inn Express Osaka City Center for JPY 22.5 billion.
At about a 4.6% appraisal yield.
Yeah, and this lines up perfectly with their strategy to grow their hospitality exposure in Japan's key urban centers. Hospitality now makes up, 19% of their total portfolio?
Okay. We also saw a significant flag change right in the heart of Singapore. The InterContinental Singapore 406 keys is rebranding to Marriott's Luxury Collection portfolio. That takes effect January 1st, 2026, when the IHG agreement expires. That's a notable shift in the luxury landscape there, especially within that Bugis Junction mixed-use development.
Definitely one to watch. And just to offer a bit of a counterpoint to all this luxury and urban focus, NRMA Parks and Resorts is doubling down on the family-friendly, nature-based holiday market. They've added 4 Central Coast holiday parks to their portfolio, taking them over from the local council. Budgewoi, Canton Beach, Nora Head, Tuan Bay. It reinforces their commitment to that domestic leisure segment and offering benefits to their MyNRMA members.
Interesting diversification. Okay. Now that we've charted the movements of capital and new assets, let's dive into Section 3, Industry Trends. And here, the financial results, well, they paint a deeply divided picture of global performance.
Yeah, the story of Q3 2025 really is divergence. Take MGM Resorts. Consolidated revenue was up slightly, 2%, but that was almost entirely anchored by a record performance from MGM China,
which saw revenue jump 17%.
Right, but the overall picture was, let's say, muddied by a net loss of $285 million, partially driven by a hefty $256 million goodwill impairment charge.
And crucially, their domestic engine, the Las Vegas Strip resorts, actually reported a 7% decline in revenue,
which they attributed to ongoing renovations and lower FPR.
Right.
So it suggests that the capital expenditures and the temporary disruption are hitting the immediate bottom line in a key domestic market.
Now, contrast that kind of stress with Choice Hotels International. They had a record quarter.
A really strong one. Net income up to $180 million. Adjusted EBITDA up 7% to a record $190.1 million.
What drove that?
Growth in their key segments. Upscale, extended stay, which saw U.S. rooms up 12% in mid-scale. But here's the really telling data point, the split. Their international RevPAR grew by an incredible 9.5%.
Wow.
That absolutely carried the load and more than offset the 3.2% decline they saw in U.S. RevPAR.
And Marriott showed a very similar pattern, didn't they?
Almost identical. Global RevPAR up just 0.5% overall, but that narrow gain was entirely thanks to strong international markets, which grew 2.6%. That compensated for the slight dip, 0.4% in the U.S. and Canada.
So the big question this raises is what specifically is driving that robust international growth, especially in APAC and Europe, that seems to be missing, or at least softer, in the U.S. right now?
Well, it's likely multifaceted. First, many international markets are probably still in a higher growth phase of the post-pandemic recovery cycle, particularly in those key Asian urban centers, while the U.S. recovery has perhaps matured or plateaued somewhat.
Okay.
Second, Choice, as we mentioned, benefited massively from their heavy investment in the extended stay segment, which is proving incredibly resilient. And third, international markets, as you're about to highlight, I think, are seeing this hyper-acceleration from major events.
This brings us perfectly to Sydney. It's the counterexample, proving domestic market strength is possible under the right conditions. August 2025 delivered their best trading results in years.
Driven by
Major events. The Lions Rugby Tour, the Sydney Marathon, those pushed the average daily rate up over 50% and occupancy up 46% year on year. That's huge. Plus, they're seeing midweek corporate demand returning, and international arrivals are nearly back to pre-pandemic levels, around 95%.
It just shows that high-impact events can absolutely buck the broader trend of domestic softness if you can attract them.
Yeah, that event dependency is something every major city needs to be looking at very closely for their recovery strategies.
Agreed.
Now, the numbers are moving, but so are the people steering these multi-billion-dollar strategies. Let's quickly run through the key movements in Section 4. Stars in motion.
Okay, a quick rundown.
Wayne Taranto is taking on the COO role at Arcadia Hospitality. Raul Calderon-Sobrino is the new general manager at Marriott International. And we saw Charmaine Wiggett-Stridham named executive housekeeping manager at Park Hyatt.
And continuing those shifts in leadership, James Clark, MIH, is now area general manager for NSW and ACT at Ovolo Hotels, timely, given their Wyndham integration. Tess Temperley has been appointed director of sales at Nuvaho's Smart Hoteliers. And Chris Greening steps in as the new general manager at TFE Hotels.
All right, now let's wrap up with the segment I think is most critical for our audience today. Section 5, Tech News. For industry leaders focused on efficiency, this section provides essential, hard data on technology's ROI. It really proves it's no longer a cost center, but a potential profit driver.
Absolutely. And the foundational finding coming from the NCO report and strongly backed up by J.D. Power's latest index is basically non-negotiable now. In 2025, reliable, seamless technology. It's a basic utility. It's like expecting the lights to work. It's not a differentiating perk anymore.
It's table stakes.
Completely. If your tech fails, guest satisfaction plummets. Wi-Fi quality and the ability to easily stream content are consistently ranked in the top 3 drivers of overall guest happiness. It really is a make-or-break element for loyalty.
And that seamlessness, that frictionless experience,
Yeah.
That's what guests demand now, isn't it?
Yes. They expect to connect their devices effortlessly. They expect uninterrupted streaming. They want intuitive smart room controls if you offer them. Essentially, if the technology reduces stress rather than adding to it, the guest feels valued. They feel taken care of.
But the real story here, for the operators listening, is how this links directly to the bottom line.
Precisely. We need to look at 2 main pathways for ROI here. First, pure revenue generation. Hotels that are successfully deploying personalization and upsell tools often deliver through the in-room tech platform or the hotel app.
Right.
They're generating between 8 and 12% more ancillary revenue. This is especially noticeable in things like F&B orders, spa bookings, maybe late checkouts. The technology acts as a really efficient, low-cost salesperson, basically presenting the right offer at the right moment.
That's significant incremental revenue, potentially.
Mm-hmm.
And then on the operational side, the efficiency gains are just as compelling, right?
Definitely. If your tech actually works reliably, you drastically reduce those calls to the front desk. You cut down on engineering or IT support calls. That directly lowers operational costs.
Fewer headaches for staff, too.
And fewer costs. Studies are showing that reliable tech can slash maintenance costs related to device management and connectivity issues by up to 35%. Plus, there's a softer benefit. Strong tech delivery enables a subtle lift in the perceived value of the stay. Sources suggest that this can actually support a raise in average daily rate by maybe 3 to 5%.
Okay, so you combine the reduction in maintenance costs, the ancillary revenue uplift, and that slight ADR bump.
And the return on investment for these targeted tech upgrades becomes incredibly fast. Often, the data suggests ROI is delivered in under 18 months.
So the message for industry leaders is crystal clear. Investing in the right technology isn't just about keeping guests happy anymore. It's a necessary operational efficiency tool that drives measurable revenue and cuts operational spending.
And loyalty, fundamentally, is built on providing that personalized, stress-free technological backbone. It's expected.
So let's connect this back to the bigger picture we discussed earlier.
Yeah.
We see all this massive capital flowing into lifestyle brands globally, Hilton's LXR, Accor's Tribe, and JO&JOE, that Wyndham Ovolo Alliance.
Right.
Given these hard numbers showing that personalized, stress-free technology is such a fundamental driver of guest satisfaction and measurable ROI, it really raises an important question for you, the listener, to consider. So how long until the definition of a lifestyle hotel shifts? Shifts away from merely being about, the interior design, the architectural flair, the cool lobby bar, and becomes primarily defined by the seamless, personalized, and truly stress-free technological experience it provides to every single guest. Something to think about. That wraps up this week's 5-Star Weekly Briefing.